They told you the future of energy was stable, secure, Canadian. They preached the gospel of ethical oil, guaranteed by geographical proximity and mutual alliances. But while the world was preoccupied, debating net zero targets and political theater, the global map was stealthily redrawn in the dark. Welcome to the 2026 energy recalibration. Washington has quietly turned the key on the world's largest proven oil reserves, and they are not sitting in Alberta. This strategic realignment with Caracas is not mere political volatility. It is the calculated execution of the Canadian energy dream. This is the macro threshold, and you're watching the era of collapse. Why did the narrative of ethical oil suddenly die? And why is your portfolio poised to hemorrhage if you remain leveraged on the north? Today, we crack the barrel wide open, exposing a betrayal measured not in barrels, but in trillions of dollars in future capital expenditures. The calculated execution we speak of is merely the facade of geopolitical maneuvering. The reality is that the true cost of global distraction is measured in lost principle and severed petrodollar allegiance. The truth is not about the crude itself, whether heavy or light, sweet or sour, but definitively about who controls the tap, and critically, who ensures the logistical stability necessary to underwrite the global reserve currency. For decades, Canada served as the ultimate security blanket, the politically stable source of heavy oil supply necessary for Gulf Coast refineries, buffering the U.S. from reliance on unstable regimes in the Middle East and elsewhere. This arrangement was built on an unquestioned assumption of permanent reciprocal strategic dependence. That assumption is now the primary driver of capital flight. The critical window for the Canadian energy sector is now slamming shut, spanning the accelerated timeline from 2024 through the terminal point of 2026. This period marks the irreversible consolidation of the Caracas agreements, creating a permanent structural impedance that renders moot any long-term competitiveness Canada once claimed. We are witnessing the nullification of billions in capex committed to the tar sands. The promise of Canadian energy, the logistical guarantee, the political stability, the certainty of supply chains, all depended on an uncontested strategic partnership with the United States. That foundation is crumbling because the cost of accessing the vast, untapped, and easily scalable heavy crude reserves of Venezuela will, by 2026, be materially lower and strategically more appealing to U.S. domestic refining infrastructure than the expensive, environmentally fraught, and highly politicized extraction methods required in the Canadian North. The issue is not just margin. It is the fundamental obsolescence of Canadian heavy crude as the strategic cornerstone of U.S. energy security. The long-term viability of pending pipeline expansion projects and the necessary capital for refinery upgrades designed specifically for Western Canadian Select, WCS, are being canceled by the market, not by regulatory hurdles. The observable decline in Alberta's forward capital expenditures is the smoking gun. Companies are pulling back, postponing, or outright abandoning mega projects because the internal rate of return required to justify the massive initial outlay, the infrastructure, the processing, the transport across politically contentious borders, is instantly destroyed by the mere threat of Venezuelan volume entering the U.S. market at scale. This structural shift is permanent because once the major Western energy majors, Exxon, Chevron, others, are fully re-engaged and have begun the necessary debt restructuring and production ramp-up in the Orinoco Belt, that capital is locked in. It is not fungible. It is committed to a new strategic anchor. The Canadian government's inability to grasp this reality, that strategic energy security is a geopolitical weapon, not a friendly trade agreement, has left the entire sector vulnerable to a calculated market shock. When the largest consumer of your single most important export signals that it has found a cheaper, more pliable alternative, your entire business model collapses instantly, irrespective of past loyalties or treaties. The market is not cruel. It is merely assessing geopolitical probability, and the probability of Canadian dominance has been marked down to zero. We must understand that this pivot is not an anomaly. It is the established pattern of how empires manage their resource logistics. To believe that Canada, the friendly neighbor, is immune to this calculated strategic disintermediation is to ignore the cold, hard precedents of global energy history. This is the rule of three, the historical pattern confirming that assured confidence and long-standing partnership treaties are always secondary to immediate geopolitical necessities, particularly those concerning the defense of the global reserve currency. The history books are littered with the corpses of energy partners who believed their strategic utility was guaranteed. Consider the devastating abandonment of the Shah of Iran in 1979. For decades, the Shah's regime was the assured pillar of U.S. strategic interests in the Middle East, the guarantor of oil flow and regional stability. Treaties were signed, trust was absolute, and capital flowed freely. Yet, when the revolutionary winds shifted and the geopolitical calculus demanded a new strategic posture, that guaranteed partnership evaporated overnight. The collapse of the Shah-S regime demonstrated the crucial principle. that the U.S. will prioritize the realignment necessary to secure its larger regional or global objectives, even if it means sacrificing a deeply invested long-term ally. Geopolitics overrides assured confidence, and assured confidence is merely an illusion underwritten by temporary alignment of interests. The second precedent is the post-U.S. shale gas crisis of the 2010s, which provides a perfect analog for how a sudden cheaper and domestically controlled alternative supplier instantly dismantles the pricing power and strategic relevance of an established, reliable, but geographically distant provider. For decades, Russian gas held enormous leverage over Europe, a dependence that seemed immutable. When the floodgates of U.S. hydraulic fracturing opened and liquefied natural gas began hitting global markets, the entire structure of Russian pricing power was undermined. It was a structural disintermediation that had nothing to do with Russian behavior at that precise moment, and everything to do with the introduction of a massive, lower-cost, politically favorable alternative. This is precisely the threat Venezuela poses to Canadian crude. The sheer scale of the Orinoco reserves, coupled with Washington's strategic blessing, creates a structural replacement that eliminates the competitive edge of high-cost Canadian extraction, rendering those vast resources economically stranded before a single new pipeline can be laid. Finally, we turn to the Suez Crisis of 1956, a pivotal moment illustrating the instant devaluation of a critical transit asset in the face of shifting global priorities and maritime logistics. The Suez Canal was, for the European powers, the indispensable choke point, the linchpin of global trade and energy transport. When geopolitical events culminated in a crisis, the immediate response from Washington was not to defend the established order, but to redefine global logistics. The eventual shift towards supertankers and alternative routes instantly devalued the perceived strategic criticality of that single bottleneck. The lesson is clear. When a strategic asset, be it a physical canal or a geopolitical partnership based on geographical proximity, becomes politically inconvenient or economically inferior, the strategic priorities shift, and the previously critical asset suffers instant devaluation. The eventual shift towards supertankers and alternative routes instantly devalued the perceived strategic criticality of that single bottleneck. We must understand the lesson is clear. When a strategic asset, be it a physical canal or a geopolitical partnership based on geographical proximity, becomes politically inconvenient or economically inferior, the strategic priorities shift, and the previously critical asset suffers instant devaluation. We now, from historical precedent, where the structural pivot was merely inevitable, to the current diagnosis, where the market is already pricing in the North American collapse. The smart money does not wait for the formal announcement. It front-runs the institutional shockwave, and the indicators of financial hemorrhage in the North are screaming louder every quarter. The most visible casualty is the increasing differential between Western Canadian Select, or WCS, and the standard West Texas Intermediate, WTI. WCS is the heavy, sour crude extracted from the tar sands, requiring significant and expensive upgrading before it can be used by U.S. Gulf Coast refineries. For years, the rationale for this discount, the differential, was based primarily on logistics, getting the landlocked crude out of Alberta and to the refiners. But the widening gap we see now is no longer purely a logistical challenge. It is a profound indictment of future market competitiveness. The discount is expanding precisely because sophisticated players anticipate the imminent arrival of massive, newly sanctioned barrels of Venezuelan heavy crude, a direct, cheaper, and faster-to-market substitute that floods the specialized refining capacity in the U.S., currently reliant on the Canadian flow. This widening WCS discount is the market AS early warning system signaling that the Canadian heavy barrel has lost its premium positioning and is heading toward becoming a residual, high-cost supply of last resort. It is a mathematical expression of terminal decline, translating a geopolitical shift directly into lost principal for every producer leveraging the North. But the real scent of rehabilitation is not found in the Canadian price discount. It's found in the distressed debt instruments of PDVSA, the Venezuelan state oil company, and the movement in their deeply discounted sovereign bonds. When a pariah state is poised for re-entry, the debt market moves first, anticipating the massive restructuring that must occur to clear the slate. This market movement is the undeniable odor of official Washington approval. Funds that specialize in high-risk, high-reward distress are now aggressively buying up this debt for pennies on the dollar, operating under the distinct understanding that future U.S. government policy will ensure Venezuela and U.S. oil revenues are harnessed to pay down or restructure those old obligations. This is not charity, it is controlled capitalism. By facilitating this debt cleanup, Washington ensures that any new capital injection into Venezuelan fields, required to bring production online quickly, is backed by Western financial and energy majors, effectively cementing U.S. regulatory control over the world's largest proven reserves, far outweighing the reserves of Saudi Arabia or Canada. This orchestrated debt rehabilitation is the financial key turning to lock out the North permanently. The final, and perhaps most definitive market indicator, is the dramatic retrenchment of big oil's forward capital expenditures, especially concerning the development of new tar sands megaprojects. For projects requiring decades of stable geopolitics and billions in upfront capex, investor confidence is the oxygen supply. The collapse of this confidence is palpable. We are witnessing global majors shedding assets and refusing to commit to new long-cycle projects in Alberta. This capital flight is a rational response to the understanding that the future price floor required to justify these extremely high-cost extraction methods has evaporated. When ExxonMobil, Shell, and others systematically pivot away from long-term Canadian commitments, they are not reacting to temporary price dips. They are reacting to structural shifts orchestrated in Washington and Caracas. They are confirming the geopolitical analysis. The competitive edge of ethical oil has been nullified, and the vast, technically extractable reserves in the North have been rendered economically moot by the sudden and calculated introduction of a subsidized, massive alternative supply. We must now lay out the timeline, the sequenced strategy employed by Washington to systematically replace Canada with Venezuela as the long-term strategic energy anchor, a strategy of strategic abandonment executed with cold efficiency. This isn't volatility, it's an operational plan, consisting of 4 distinct phases that define Ottawa's ultimate abandonment. The first phase, already executed during 2024, centered on sanctions relief and production testing. Washington initiated this phase by granting highly specific and temporary licenses to Western companies, primarily Chevron, allowing them to test existing infrastructure and conduct limited production exports. The official narrative positioned this as a humanitarian measure aimed at easing global oil prices. In reality, it was a critical intelligence gathering exercise. It allowed the U.S. to assess PDVSA's physical capacity, calculate the true cost and timeline required to restore output to viable levels, and, crucially, measure the domestic and international political blowback. This production testing phase was a successful proof of concept, establishing that the infrastructure was recoverable, and that the global political cost of rapprochement with Caracas was lower than the long-term strategic benefit of securing those reserves. This confirmed to Washington that the strategic pivot was executable at a minimal political expense. The second phase, which we anticipate dominating 2025, involves the debt restructuring and strategic capital injection. As hinted by the bond market activity, this phase formalizes the financial mechanism for the pivot. Washington will subtly pressure or facilitate a significant debt restructuring deal, offering PDVSA a clean slate, provided that future oil concession agreements are highly favorable to U.S.-aligned energy majors. This is the institutional takeover. New strategic capital, backed by powerful Western players, will flood the Venezuelan fields, not just to increase production, but to ensure that the physical infrastructure and output logistics are secured under Western operational control, mitigating the risk of nationalization and providing a reliable, politically hedged supply anchor for decades to come. This injection locks in the relationship financially, making any return to full sanctions economically devastating for the majors involved. This phase ensures the U.S. controls the operational output, while Canada remains a high-cost, high-friction minority supplier. Phase 3, culminating in 2026, is the point of no return, the signing of long-term bilateral energy security pacts. This phase represents the formal replacement of Canada. Washington will sign comprehensive treaties with Caracas, guaranteeing sustained high-volume oil supply in exchange for formalized security agreements and further economic integration. These pacts will establish pricing mechanisms and volume commitments designed specifically to stabilize the geopolitical landscape and anchor the global heavy crude market. Critically, these bilateral agreements will create the structural impedance that permanently nullifies the competitive edge of Canadian oil. By guaranteeing long-term, politically secured supply from the south, the investment case for high-cost, high-friction supply from the north collapses entirely.